Hey guys, Toby Mathis here, and today we're going to go over what is dealer status when you are involved in real estate, what it is, whether it's good or bad, and how it'll affect you. And I'm just going to go diving right on in. Number one, when you are in real estate investing, one of the big benefits to being an investor in real estate is this thing called depreciation. And depreciation, as a concept, is the building that is on the land that you buy. You get to deduct a portion of that building every year that you own it. In other words, you built it. Let's say that you bought a $1 million property. We subtract out the land. We do not depreciate the land. We get no deduction for land. So let's say the land is 20%. So there's $800,000 of improvement on that property. That $800,000, we are going to deduct that $800,000 over a period of years. That's called its useful life. Now, if you have a regular accountant, they're going to look at it and say, is it residential or non-residential? In other words, is 80% or more of that unit being used to house people? As an investment, this makes a big difference because your deduction is 27 and a half years versus 39. And I'm going to write that up. 27 and a half years versus 39. 39 is non-residential. 27 and a half is residential, and that's what a lot of accountants go towards. It's called the Modified Accelerated Cost Recovery System, and all that means is if I have that 800,000, just imagine that you're dividing it by 27 and a half, and you're going to take that amount and as a deduction every year. It's not quite that simple. We have a half-year convention. The first year is going to be a little bit less, but that's the theory. And so people like investing in real estate because let's say that you bought that building, you bought it on financing, so maybe you put some money down and you bought that $1 million building, maybe it cost you 200 grand, and then you have these rents coming in every year, and you get a deduction just for showing up. So whatever that might be every year, you might find that you are not actually having to pay tax on much, if any, of that income. Now, if you are paying tax on that income, then we get to have fun with this. This is where we get to say, hey, you know what? The default might be 27 and a half years, but what the appropriate mechanism is to take that building and break it into its components and figure out what property is in that 15-year area, which means land improvements, things like the parking lot, trees, shrubs, plants, putting in all sorts of stuff, a fence. All those things are actually 15-year property. And then you have 5 and 7-year property. Things like, hey, cabinets, appliances, electric systems brought to things that have a useful life of 5 or 7 years. Think of a dishwasher, right, in a single-family residence, and the plumbing and the electric brought to that is actually considered 5-year property. Things like your carpeting or removable flooring or window coverings, all those things are 5 and 7-year property, which means I can write them off quicker. So I'm just going to say, as a matter of course, you're probably looking at about 25% of that purchase price. It's 25% is probably a good figure to use that we're going to get to write off immediately over these shorter terms. So let's say again, same idea. We bought a building, $1 million. I'm probably looking at a $250,000 deduction in year one. Probably right in that range, maybe $200,000 to $250,000. I'm not joking, that you can write off. That's called a cost segregation. You just get a cost segregation study, and then there's a way to accelerate that into 1 year. It's called bonus depreciation. Depending on the year that you purchased that property and put it into service, not just buy it, but that you put it into service as an investment property, I get all those advantages. Now, here's another advantage that you get when you're an investor in real estate. If I want to sell this property and buy another, I can do something called a 1031 exchange. A 1031 exchange allows me to avoid tax on gain and even the recapture on any of that depreciation I took. I can get out of that property, and as long as I buy other real estate, and it could be one or more properties, as long as I buy additional real estate and I use a 1031 exchange facilitator, qualified intermediary is what it's called, a QI, then I don't have to pay any tax. I can push it forward. That's why people love real estate. And then get this, when I pass, I do this my whole life, and I eventually pass away, my family gets what's called a step up in basis, which means never have to pay tax on any of that growth. It's crazy how many benefits are tied into real estate, which is why wealthy people love real estate. I get these huge benefits. But now here's the rub. I wanted to talk to you about dealer. This is for investors. When you are a dealer, you are not an investor. And I want to talk about what a dealer is. A dealer buys to sell. They buys to sell. In other words, when they buy property, they're not buying it for the long-term hold. They're buying it because they're going to fix it up and sell it, or they're going to buy it with the intent to sell it, not with the intent to hold it. The people that fall into this category, you're always going to hear the term flippers. This is where your flippers live. This is where your rehabbers live that sell properties. People that improve property and then sell it fall in this category. And now here's the problem. You don't get depreciation when you're a dealer. So you get no depreciation. No depreciation. You get no 1031 exchange. You get no ability to do even what's called an installment sale, which is another benefit of being an investor. You could sell things over time. So there's no installments. What you do get is ordinary income treatment subject to self-employment taxes. So you get ordinary active income when you are a dealer. And that's why it's so important to understand the distinction. You are basically a car lot. So think of this. You go down to your Ford dealer. They buy cars to sell the car. Their inventory is sitting on their lot. They are not depreciating those cars. They don't get to depreciate them like you or I would if we used it in our business, because that is inventory. When you are a dealer, your houses or your properties, whether they be residential or non-residential, are going to be considered inventory, which means you don't depreciate them. If you improve it, you add it to basis, and you get the deduction for all the improvements and everything you did when you sell the property. It just adjusts the basis so there's less ordinary income. That's it. And I always get this question, well, then you just hold it for a year and you make it an investor. That is not the deal. There's actually court cases where individuals held property for 10 years and they were still deemed to be a dealer. Why? Because it was clear when they purchased it that they were trying to sell it immediately. And the economy shifted. They weren't able to get the price they wanted, so they turned it into an investment property for a period of time, and they continued to try to sell it. They continued to, and then the economy improved, and they finally sold it 10 years later. And the court was able to say, the IRS made the argument and the court bought it. These guys bought the property to sell it. They did not buy it as a long-term hold. So there's all these benefits over here for investors that you lose when you are a dealer. When you're a dealer, you are an active business. Now, how do we treat it if we're doing both? I know people that do both. And by the way, this is where wholesalers, construction, real estate agents, all of you guys are active businesses. You're not investors on that business. So like if you're a realtor and you're buying investment property, you would never just combine your realtor business and start throwing everything, like if it's Toby's real estate or Toby real estate services or real estate brokerage, I would never start buying properties in that brokerage, right? I'm going to set that up in a structure. Usually I'm going to have it treated as an S corp for tax purposes. So I might be an LLC taxed as an S corp, or I might be a actual S corp for reasons of getting an accountable plan and because the profits that flow out of there are not subject to employment taxes, so I get some tax relief, right? That's probably what I'm doing. If you could do dealer even as a C Corp. So for example, if you are a high income earner and you're saying, hey, I'm just gonna keep flipping properties, and what I wanna do is grow that, and I wanna grow that business, you might make it a C Corp so it doesn't hit you personally for taxes and you have a flat 21% tax rate. So there's different options you have as a dealer, but you are definitely an active business. And I always use Toby's Pizza Shop when I'm using my examples. You are a pizza shop. You are not the investor. Toby, the investor, buys property and holds them long term. I'm never going to buy them in my individual name. I'm going to use a series of land trusts and LLCs, depending on the state and where I'm buying and whether there's debt involved. But I'm going to not own it in my personal name, but it's going to flow onto my personal tax return. I definitely want my investment activity flowing onto my 1040. It's going to do it on Schedule E. When you are a dealer, you don't get Schedule E. You get Schedule C, which, by the way, is the highest audit category that like when I look at the audit categories, actually, if you make over 10 million bucks, you start putting a bullseye in your back. They're going to audit you periodically. But from a percentage standpoint, when I put a sole proprietor next to a regular individual or an S Corp or a partnership, the Schedule C filer, the person who's a sole proprietor, is about 800 to 1,000% more likely to get audited. And then get this, the last year we have this study, it was table 17B of publication 55. The last year, full year that we have the study done was 2019. The lose rate for sole proprietors, the percentage of times that they lose their audits is about 94 to 95% of the time, depending on whether it's correspondence or field. It's quite literally, you have a 94 to 95% chance of losing your audit, and you have 1,000% higher chance of being audited if you are a dealer doing it as a sole proprietorship. If you are putting your dealer activity, if you're flipping houses and you're putting it on your Schedule C, you may as well just ask to be audited. You should never do that. You're going to want to use an S Corp or a C Corp or an LLC tax as an S Corp or an LLC tax as a C Corp. Just reach out to us. We will give you your options and we'll show you how to minimize the tax. Now, it's not all sad. When we have ordinary active income, that type of income can fund things like DB plans. So this comes up, here's the good. You could have a DB plan, you could have a 401k, you could do your HSA, you could do your IRA. That's active income where you can actually fund those types of plans that you cannot do with investment income. And so there is a benefit to actually running as a traditional business when you are a dealer. So what it really comes down to is, as you're looking at these things, what are the downsides? I don't want no surprises. So I need to be clear, open eyes. What type of activity am I engaged in? How is it going to be treated? What are my options when I exit? And how do I minimize any of the negative tax consequences and maximize the positive consequences? You do that. And by the way, a lot of people don't know what a DB plan is. I'll just tell you, it's a defined benefit plan where we're reverse engineering the type of retirement plan you're doing. So a lot of times people think of like an IRA. Hey, I could put, whatever year it is, $7,000, $6,500, $5,000, whatever it is, right? I can put that much into the plan. In a DB plan, they're looking at your income and you're saying, in order for you to get that same amount of income when you retire, an actuary reverse engineers it and says, well, then you need to have this much money in your plan. So if you are a dealer and you've had success, you're making $200,000, $300,000 a year, maybe you're making $150,000, whatever it is, how much money would you need to have in your retirement plan to receive $150,000 a year when you retire? Well, an actuary does that, and you could actually be putting, in some of these plans, we have folks that are above $500,000. So you just say, excuse me, I want to put above $500,000 in DB plans. A lot of times they're $100,000, $200,000, $300,000 a year into those types of plans. You can't do that over here. You can do that over here, and we could deliberately set it up in such a way to where you're just literally dumping all of your income into a retirement plan so you're not paying any tax on it. Well, you could do that with the dealer, can't do that with the investor. But the first thing is recognizing what the activity is. So once you recognize, okay, my activity that I'm doing here, these types of activities, this is how it's going to be treated from a tax standpoint, then I could put a plan in place to get the most benefit humanly possible out of that activity. And when you start doing that, you'll be surprised at what kind of opens up. So a lot of people, they look at dealer and they immediately go, ah, crud, I don't get to depreciate, I lose my 1031, I can't 453 it, which is installment sale. Oh, this is really horrible. I have active ordinary income. I'm going to have self-employment tax on it and everything else. Other people look at it and go, wait a second, that opened up a door for me to actually use a tax deferred account, and I can actually push my money in there. And yes, I can actually invest in real estate inside those tax deferred accounts too. You don't want to flip inside them because they'll be subject to UBIT, unrelated business income tax. But you get these benefits that wouldn't otherwise be available to you. So it's not all doom and gloom when you're a dealer. I don't want you to think that. What I want you to just recognize is that it's a very specific type of activity, just like any other business activity you'd be involved in. So now that we've gone through this, what is a dealer? What is an investor? An investor buys for the long term, and they get certain types of benefits. They can do 1031 exchanges. They get that step up in basis on that asset. They can do something called an installment sale on there. They get the depreciation, so they get big fat deductions. And all that income, none of it is subject to self-employment tax if you're an investor. Then on the dealer side, what is a dealer? A dealer is somebody who buys real estate with the intent to sell it. And they do a facts and circumstances test. Whenever you look at the court cases, it's like, here's what we look at, what type of advertising you did, what your history is, when you bought it, were you already listing it? Did you have professional sales? Was it clear from the outset, in other words, that you weren't buying this to hold it for a long period of time? You were buying it because you were going to fix it up and sell it, or you were going to buy it and put land improvements and sell it, or you were going to buy it and you're fixing it up or just holding it and trying to get in the way of progress with the intent that you're going to sell it in a year or two. It doesn't matter what your holding period is. They're going to look at those factors and they're going to decide, did you buy it to sell it? If the answer is yes, no depreciation, no 1031 exchange, no installment sale. It's ordinary income, subject to self-employment tax if you're materially participating in that activity, which, if you're flipping and you're doing the rehabbing, yes, you are. And if that's the case, then it's just regular business income, but it opens up a bunch of doors to you because that's a very specific type of income that you can get other benefits out of if you know what you're doing. So step number one is identifying the type of activity. Step number two is what are the opportunities that are presented by that activity, and those benefits could be great.